And I think we've turned the corner. There's going to be more inflation coming. There's going to be an exodus of capital out of the US. I think it's hard to beat oil services across the board as a sector. It's a sector that has been absolutely massacred. No one even talks about rhodium. It's too small. No one cares. I think it's had 5 bull markets where it's done 10x plus. Some circumstances it's done 30x plus.
Cat Calls is designed for entertainment and information purposes only. These are not stock recommendations. Take the advice of a registered financial advisor. Enjoy the ride with us, but do your own work. Trader Ferg Simon Catt from Cat Calls, CATTCASS.com. Mate, you have made a name for yourself as a trader with a very open philosophy to sharing about how and why you've done it. Would you mind if we went back to the beginning about where you came from? I understand that you've got some New Zealand ancestry. Why did you decide to become a trader? Is that just fit in with your lifestyle where you like to travel? You can do that wherever you are, or where does that come from and where's it going in terms of a life choice?
Yeah, so it wasn't something I ever intended to do, honestly. So I grew up on a farm in New Zealand.
Mm.
Farmer's son, got a rugby scholarship to Farmers University, Lincoln University down at Christchurch. Pretty much intended to go farming until I kind of realized that it was a pretty tough business, and switched in university to finance and ended up getting a job in asset management in Australia. And that's it's one of those things when you kind of have all your goals and then you kind of start ticking the boxes and realize it's not what you wanted at all. And I found myself kind of leading a team in Australia and having the corner office wearing a suit every day, and I was miserable. So then started trying to look for a way out. Like, how can I be my own boss? Because I'd kind of seen dad throughout my life. He was always, with farming, he was his own boss. We could take a holiday whenever we wanted. He was always in charge. And so explored a few things, and the one that kind of appealed to me, because I'm a bit of an introvert, I'm a terrible sort of salesperson or
Hmm.
doing anything that involves kind of being on the phone all day or meeting people. And so trading appealed to me, and I was lucky enough. The real turning point for me was I met my mentor, who I've had ever since. So over 10 years now, coming up 15 years almost, is Brad McFadden, who runs a fund. And I was lucky enough to see him at a conference, and he was just outlining his trading philosophy, which was hunting out some deep value in mainly cyclical areas and positioning there for sort of asymmetric upside. And
Mm.
that just clicked with me because I kind of seen dad do it in farming, like kind of get in early to areas that with hindsight turned out to be really cyclical. The people that got in early, like whether it was deer farming in New Zealand, because we were a sheep and beef, and then there was this deer became all the rage for a few years, and then
Mm.
everyone got into it. Of course, the boom bust cycle. And I'd
Mm.
kind of seen that, and I was like, "What?" So I get to kind of play that game on the world stage, and so it just clicked to me. Yeah, I'd kind of quit my job by the time I turned 30, made enough to have a go of it, and just turned 40. And yeah, been at it for 10 years now, and things have turned out pretty well.
Good for you, buddy. Yeah, I understand that the familial background. My father's a furniture maker. I used to watch him leave early in the morning and come back late at night, and then after dinner he'd be designing furniture with his design board. And he was working all the time. And when they said, Mum and Dad said, "Do you want to, take over the family business in furniture?" I'm like, "Absolutely not. That looks way too hard." Apart from not having any manual skills to actually make the stuff or design it. And yeah, finding a way to being an investor, I find it's a lifetime of lessons. Every cycle's different. You're always learning and always trying to battle your worst human instincts.
100%. Yeah.
What would you say your kind of visceral learning experiences where you've like, oh my God, that was painful. I'm not going to do that again. What would you say has really formed your trading style?
How long do you have? I feel like I make a new a new big mistake every year or two.
Yeah.
Um, so the really formative ones that really hurt, I lost my entire brokerage in the first 2 years when I was actually doing well with it. So being in Australia, I don't know if you heard of BBY. It was
BBY, yeah, I
yeah,
recall back in the
yeah,
90s. Yeah, I was working in Sydney at the time. I recall the name of the firm.
yeah. So they blew up and took my money with them. Well, I actually got it back. I got it back about a year ago, which didn't really matter
Oh,
much
well.
to me. But after the the auditor's fees, which they cut it in half. But yeah, so yeah, that was the first real test when I kind of found my footing, and then yeah, just the old story of some horrific drawdowns at the start, learning that I'm a terrible leverage trader. It's one of my kind
Mm,
of rules now is I've got zero ability to trade with futures, CFDs, on even on margin, like anything that involves like stop losses, and I'm
mm,
just terrible with that. And that's when I found kind of Brad's approach that just made all the sense in the world to me. Kind of like find something that's you've got a big margin of safety, it's been left for dead, and your position size is almost a stop loss. Like you size it in such a way that you accept the downside and you know that you can lose 100% of your money, and the upside and can be, if you get it right, can be really attractive. And so with that kind of framing, then yeah, things started to work a lot better. But yeah, needless to say, continue to learn lessons, have drawdowns, have run a bit more volatility than I like, which I'm trying to dial down every few years. I guess having kids and not needing to push it as hard as well kind of helps dial it down a bit over time. But yeah.
So, in terms of the lessons you take from those learnings, Ferg, you've got like the broker went bust. How do you manage against that risk? Do you just have to have a number of brokers and pots of money? So if one goes bust, it's not the end.
Yeah, so I definitely did more research on my brokers. So after that, kind of went right down the like the short report side of finding
Mm,
out who had the more solid balance sheets, and ended up on IBKR, which is what I
yes.
now do the bulk of my trading. Even with that said, I kind of want enough to recapitalize myself, so I keep a decent amount in, which I'm constantly trying to build up in like kind of storage, physical metals and storage, actively trying to actually, which I'm going to be doing more of the next year or two, going and opening kind of like little brokerages around the world to buy stuff that I can't get access to via
Would that be like
IB.
rhodium or something?
Yeah, yeah, yeah. So stuff I can't get access to with IBKR. First bought it in Saxo, and then not that happy with Saxo, and so then looking at stuff like Standard Bank in South Africa, and then the the advantage of that is then you get access to like the JSE, the
Yes.
exchange operated there, which is a fantastic company, and you can't buy it via IBKR. Yeah, and then repeat that as well. Like there's some really attractive exchanges if you're prepared to do the work. Like in South America, I'm determined to get access to the NAM exchange, which is kind of a after Chile went through its kind of socialist period and largely sort of caused international investors to run away, the exchange largely collapsed, and then it's come back now and had a sort of a not a merger, but they're all held under one entity now between Colombia, Peru. They've got a decent holding of some financials in Brazil, and it's all held
And
under,
Chile?
yeah, in Chile. They've
Yeah.
recently had some secondary listing in Colombia, which makes it easy because getting opening brokerages in Chile is a nightmare. And so that's something I'm actively working on, kind of just squirrel a bit of money away there. So same with the Argentine exchange. Yeah, I love that angle of kind of helping diversify a bit of risk as well, not having all the eggs in one basket.
Makes sense. Yeah, I looked at trying to buy a Santiago listed Chilean copper producer called Puecobre, Pucobre, last year, having gone there and with another Canadian listed junior run by a friend, Fitzroy. And I thought the partner sounded like a great copper miner, and I visited their assets. And then I tried to buy the shares, and I couldn't actually get an account open in Santiago. So it sounds
No,
like
it's
the
so hard.
NAM exchange, NAM, NAM, is that what people look for?
NUAM. Yeah.
NUAM.
Yeah.
Okay,
Yeah. I
take
can
a look
send
at
it
that.
to you afterwards. Yeah. It's
Sure,
super interesting because you kind of, with Chile, it's essentially like a proxy long copper, and um, and you get in, so you get the combination of them all for sort of around 500, just over 500 million US. Nice dividend. You get Colombia's upside, which all of the countries with them starting to go more to the right, things are looking pretty attractive. And you can look at some of the examples, like you can make absolutely crazy returns if you're willing to get into, take like the Polish, like the Warsaw Exchange. That's been an absolute tremendous investment. You collected dividends along the way. If you reinvested them, you've got an absolute monster of a compounder. And if they'll give you squirrel some money away in a few of these, like there's even some I'm looking at, like Uzbekistan, like some of those like
My God,
really,
that is
yeah,
off-piste. Are
yeah,
you
yeah,
buying individual stocks or ETFs that are baskets of the stocks with these exchanges?
buying the exchanges themselves by the actual operator.
Oh, I
Yeah,
understand. Okay. So it's a proxy on the growth of the securities business in that country and the underlying economy.
exactly. So it's been a big sort of aha moment for me was actually originally a piece by Horizon Kinetics, and they just went through the entire
Mm,
history of the exchange business model, and almost in every circumstance, I'm trying to think of when it. The only times it really goes wrong is what I just pointed out in Chile, when you have a real socialist swing
yes.
and you have a capital exodus, and they run on obviously on liquidity, like investor capital, and so the exchange collapses on the back of that. That's how you get really dusted. But on the
Mm,
other side, most of the exchanges have tremendously outperformed the underlying index. They're a capital light business model. They've
yep.
got a very high sort of moat when you think off. A lot of them just swallow up their competitors.
Yes.
They do very well in inflation. They do very well in volatility. It's a surprising business model how kind of anti-fragile it is, in that it benefits from a lot of situations that don't benefit the broad index in a way that they, like higher inflation drives more trading activity. Even sort of crazy volatile times actually drives more trading activity, which helps kind of cushion the damage that the economy might otherwise be having. Like a good example is Greece. Like if you bought it's now been acquired by, forgetting which European exchange, you can't buy it anymore. But the Greek exchange, if you'd invested in the Greek index from, I think it was run over a 20-year period, you were down, you were in this sort of negative, I think it was like 10-20% return over that period with the whole blow up Greece had. But you still came
Mm,
away with 100% return in the exchange. And then you've got the absolute crazy outliers, like if you bought, like if you just bought the NASDAQ exchange, you actually outperformed the NASDAQ, which has been obviously the best performing, and you've even outperformed some of the crazy performers from when it listed. You would have outperformed the likes of Microsoft. You would have outperformed, yeah. It's fascinating. The more I dug into it, the more I've kind of built a portfolio for my son around it.
nice, nice. I was going to
Mm.
ask you about, well, there's two things, isn't there, with family and independence or children? Is it's point one is like providing for them and the family, and point two is how you think about advising them to be their own financial stewards in the future. Is your son old enough for you to pass on those lessons, or at the moment you're just building wealth for the family?
The moment I was building wealth, he's only 3.5. I don't think
Right.
he's particularly
Okay.
interested in my.
He's not trading yet.
No, he's more interested in, yeah, what toys I'll buy him. Yeah,
Yeah.
no, this is more a, yeah, just set him up. And I just love when you get something that you can just see compounding, like something like I love, and it's how I built the majority of my wealth, is kind of like digging into like hated stuff and doing the asymmetric, and often, like I've talked about, like buying roadkill and toxic waste, which is one style. But the other style is also finding something that's got like a high shareholder yield, like nice solid dividends, buybacks, a tough moat, and you can see that being sustainable for a long period. And you can see inflation not damaging it. You can see just a solid competitive moat that has a long runway, especially when you add the currency. Because how I position his portfolio is like, why are these businesses not done better the last decade? And the
Mm.
simple answer is, like, imagine them like a kind of like a highway toll road that
Needs traffic.
needs traffic through them, and that hasn't been happening with the US sucking out all the liquidity. And so, why I think that's turned is, if you look at a basket of these currencies, they've already been outperforming the last 12 months. The majority of the exchanges I own, the currencies kind of found the bottom and has been outperforming the US dollar. And if you were, say, take Brazil, like Brazil, you've had an absolute horrible time, um, in currency terms. Like, not only has the US been hoovering up all the capital with the outperformance of tech and now AI, but obviously the dollar's been strong on the back of it. Whereas if you'd been
Right.
hanging out in the real, like I think you've got over the last decade, you've been dusted to the tune of sort of 300%, which is which really hurts. And yeah, take that across a lot of these names. Like, that's why even if the exchange was actually attractive, like it just on a currency adjusted basis, it made no sense. And I think we've turned the corner, and what we're seeing in the US is, especially with what Trump's just doing now, I think I think there's going to be more inflation coming. There's going to be an exodus of capital out of the US, and a lot of these names are going to be very attractive, and the exchanges are going to be there. The exchange operators will benefit handsomely.
Yeah, makes sense. Yeah, so I got that. So for your point is, so the emerging market exchange, the Brazils, the Uzbekistans, the Polands, etc., South Africa you mentioned, they're
Mm,
really anti-dollar trades.
mhm.
And I think we've got a president who says he wants the dollar to go weaker to get his trade balance. He's got his tariff strategy, so that makes complete sense. And then within that, the nominal growth, the inflation of the underlying constituents of those exchanges and the fact those economies are also turbocharged by a weaker dollar and therefore a stronger local currency means that you've got a couple of powerful network effects and grows in nominal assets which drive the profitability of those local exchanges.
Yeah, 100%. It's set up in like I kind of said it was like a 60-40 for the next decade, and that 40% is the EM exchanges, 20% is EM banks, because they also have this beautiful kind of virtuous loop when the dollar weakens, inflates their balance sheets, their earnings, more loans, more. It just kicks off like a virtuous cycle for them. And then the other 40 is kind of all the sort of halo. I like that term, like the um, heavy asset, low obsolescence, like you got your um, oil and gas, fertilizer, coal, even tobacco, just a whole lot of like sort of heavy industry, high dividend, sort of sustainable cash flows out as far as the eye can see. Yeah, we're unpacking Hugo's money.
Hugo, your boy, nice.
Yeah.
Yeah, the before we come back to halo assets and cyclical bets, for my son Oliver, who's 20 years of age, just arrived in Sydney to do a year abroad studying economics there. So he started to invest his money because he was watching dad back when he was 7 or 8 years of age. We used to go living in London, used to go down to the Westfield shopping centre, and they had a Tesla showroom there, and so we used to go and sit in it, and we even took it for a test drive even though I had no plan to buy a Tesla. And so at some point he said, Dad, can I buy shares in Tesla? And we said, well, yeah, you can. And he was at the time, so I think this is about 2016. So we had a bit of a research about it. He had a little portfolio of shares that he was investing in, which is the same kind of stuff that Dad did. Anyway, it was the same time as the Volkswagen Dieselgate scandal. And I said, well, look, we can buy some Tesla shares, but you can also buy this company called Volkswagen, and they make 10 million cars a year, and Tesla makes about 10,000 a year, and Tesla's more valuable than Volkswagen. So maybe you should buy some Volkswagen instead of some Tesla. And that was, of course, around 2016, 17.
Yeah. Yeah.
So back to the lessons that you learn and that you try and impart with your son or your children. It's like, what did Oliver learn from that? He said, "Don't trust dad. Do your own
Yeah.
work." Tesla went up
100%.
7 times. I think you made 10% on his Volkswagen and should have bought the Tesla.
Yeah. Well, that's
So
what's
we've all got our prejudices.
Tesla's hard because yeah, that kind of story stock, you never like it, fundamentals never mattered. Valuation didn't matter. Like I think it matters at some point, but it hasn't mattered for a long time. And you get absolutely beaten over the head by the stock price, as you say. Like it didn't matter if you pointed at 1,000 PE or something. It just didn't. None of it was relevant for for a long time.
What made the shares go up? Well,
Yeah.
SpaceX is an example. So, Ferg, tell me, do you think we're in a bubble, an AI bubble, a stock market bubble? And if so, how do you prepare for that as an investor? And for reference, it's now the 4th of August, 2026.
Yeah, so the way I come at it, I just want easy beats on expectations. And for me, like the expectations when I look across the AI space is it's through the roof, and it's going to be so difficult to move them moving forward. Like using SpaceX, if you just look at what the average analyst expects from that company for the next 5 years, they have to double sales every year for the next 5 years, more or less, slightly under that. They have to double earnings every year for the next 5 years. And if you look at and that company is already on that valuation. Like, where's that money going to come from? Even if you look through their their IPO'd on their document, like it's vast majority of the valuation was actually on the sort of AI side of the business.
Yes.
You can do the same with Nvidia. Like Nvidia is currently what 250 billion of sales. They average analyst expects that to grow by 80% next year. They've already kind of lost out of China. China's already getting a lot of its companies to now just purely use Huawei. And you just make it very hard for yourself in this game if you're trying to live up to those sort of expectations. Like with Nvidia, you're already at just a crazy, crazy market cap. And it's why I think you're already seeing these kind of circular sort
Funding
of
around.
games, yeah,
Yeah.
to prop up. And I just want nothing to do with that. So yeah, I think it's a bubble. I think it's how long it can all go on. I've got no idea. I don't like to play that game. I don't like to short ends too hard. But back to kind of Tesla, anyone that's made sort of a fundamental case on Tesla for years now has just been run over. The smarter way
Yes.
is just to put your hands in the air and say, I've got no idea how long this might go on. I know it's ultimately not sustainable. I'm going to go and find something that I think is sustainable and I can, like one of the best things Brad taught me was just ask yourself, does this make sense on a sort of a 5 year time frame? Like, do I want to be here in sort of 5 years out? Like, think longer term than everyone today. All the smart money's competing on sort of 1 year time frames, and it's just
Or
hard.
less.
Like, or even less, yeah, it's quarterly, yeah. And so when you get drawn into that time frame, every time I kind of, with hindsight, looking at a mistake was I got drawn into like shorter term. Even recently with the war, like I put some options on grains because I thought the risk reward was great. And stepping back, I was like, I always lose money when I get drawn into a shorter term time frame, and I always have this. It's actually fantastic. I don't know if a lot of people know that you can plug in Claude to your IBKR and kind of analyze your own results and say like, what are my weaknesses, what are my strengths, and see. Brad actually did it to me like years and years ago. Was I was giving him a big spiel on how I thought I had an angle with forex options, and he's like, "Just open up your account and show me your P&L for the last like year. What actually made you money?" And like the thing that I was spending all my time on was like maybe 10% of my P&L, and the thing that I was giving barely any time to was making me all the money. He's like, "Just do more of what works," and so
Totally.
that's something that I've tried to just constantly bring myself back to is do more of what works. Don't try and be too smart in areas that you compete with a lot of smart people. Extend your time frame. Make sure you can stay at the table. Don't there's a big graveyard of people that had the right view but expressed it in a poor way, whether via leverage and got taken out. There's nothing more painful than having the right view and getting taken out only to see the sort of what you thought would happen then play out in the market. And I've had
Yes.
that happen to me. And
Yeah.
yeah,
Amen to that. Yeah. So yeah, being brave enough to have Claude analyze your trading record. That's, you know what, I have not done that. I have had it analyze my tax returns, and plugging in 10 years of trading statements, and notice that, it's not even the 80/20 rule. It's the 10/90 rule, where 10% of your trades make all the money and 90% of it you're just churning yourself around for no real gain. And the lesson, I read your trading rules of thumb, Ferg, is sometimes the best thing to do is just nothing.
100% is it's often trying to be active works against you in a big way because like one of the hardest lessons to realize is often you can look back at a portfolio and you had the right portfolio, but you just overthought everything, chopped everything around, and you might have done okay, but your performance would have been better if you just left it alone. Yeah, and that often hurts when you realize. Like I joke I've got some tickers I can't even look at anymore because they just they just irritate me too much. I knew what I was in there for. I knew where I got out, and now seeing where it is now, yeah, would be more than all my sort of efforts since that's pure asymmetry of just closing their brokerage and walking away for a few years.
Yeah,
Yeah.
no, I read in your online commentary that you and I both had the Peabody coal trade in common.
Mm. Yep.
One of my buddies who runs money flagged it to me during COVID and said, "Hey, I think this is your kind of risk reward, death or glory." They just had just come out, and Peabody had, and said, "Look, we're in danger of going bust. We might not meet our bond refinancing deadline." So
like I think you did, Ferg, I did the math and I had a look at their balance sheet, read the financial statements, and realized that they were forced to make that disclosure about maybe going bust because of their disclosure requirements, but they were unlikely to go bust. And if you didn't mind investing in coal, which was certainly very contrarian at the time, gosh, it was such a wonderful trade. But my unhappy ending to that story is because I had leverage on the trade, I got closed out
Yeah.
long because of the volatility. And it's like a bad breakup with a girlfriend. I find it hard to go back there because I got the call right, made a bit of money, but basically couldn't stay the journey because I had leverage.
Yeah, I heard that unfortunately, that story is so common, and that's something that you understand it's gonna work, but you feel the need to add leverage to it because of the
Yes,
conviction, then
right.
takes you out. Yeah. Yeah, which is it's an unfortunate reality. Like I've actually I had it. One of my better performing trades at the moment is a company, Saipem. Why I tell that story is I actually had the trade on, and the company pretty much went. There was such a big recap that I got completely wiped out in it, and I didn't even want to look at the company again until Brad started talking about when the how the company had cleaned up its balance sheet after the restructuring. He thought it was the best thing since sliced bread, and was buying it. And I almost couldn't bring myself to look at it again because I had PTSD from it, and managed to overcome that and get back in. And then that's since like 10 back. And so, yeah, there is often, forget where I read it, but there's even a study of like how much you would outperform if you like leverage just the standard index. And then when you dig into the notes, it's the fact that they been pure sort of academic study, even if you go bust, they just assume that you buy straight back in. And that's the assumption that really matters in that you, even if you did get liquidated, you did buy back in with leverage from that point. Yeah.
Emotionally, it's hard to do. It's hard to go back
Mental,
when
it's a mental game. Yeah. This is a very mental game. You don't actually have to be that smart if you've got sort of ice in your veins and can zoom out. Yeah.
totally. So it's August 2026. We all want a 10 bagger. What are your favorite ideas for the next 10 bagger or two?
From here, I think it's hard to beat oil services
Okay.
across the board as a sector. I think that's probably one of the more attractive sectors. I think what we're seeing, one of the big takeaways from what's going on um, in Iran and with the war is the fact there's going to be a real premium on energy resiliency. And that's a sector that has been absolutely massacred. And so
Yeah.
I've got this one big, I love creating these consolidation trees in which you have across offshore drilling, across engineering, procurement, construction, installation, across contractors, and across premium tubing and casing. There was roughly 130 to 140 companies. That's been consolidated down to about 30 companies now. And it's even lower if you consider the ones that are still working through administration. They might still be in private hands. They haven't actually come back to the market, so you can't actually buy them. And so that space has just been so consolidated, so starved of money that as with the sort of the requirement for more resiliency in the energy space in this world, as money starts to flow in that, you very quickly hit utilization across a lot of these businesses, and then a lot of the money starts to flow to the bottom line just because they've had such a rough time. So that's one of my favorite areas to hunt. Other ones would be like coal. I love coal just as a like kind of like break the glass, easiest switch to flip for energy resiliency, especially across Asia. Coal's obviously been hated for a while. You get in at very cheap valuations, get nice shareholder yields on a lot of these companies.
Yeah.
Then jumping across to precious metal side, I'm a massive bull on PGMs,
Yep.
and I really latch on to anything that I think I can understand from my sort of just setting out to understand the little sector with my sort of limited resources here. Like I love PGMs because there's really only a handful of names. You've really only got Valterra, Sibanye, Impala, and Nornickel, the major players. And so you just need to sit down for an afternoon and read a few guidances. You can see what they're setting aside for capex. You can see what their production is to develop, and then to develop quite a sort of conviction with a thesis. And the sort of steep decline in the mine lives, the fact that I believe the sort of demand side story was quite wrong. And like I've kind of written a really big post on this, and the fact that a lot of the bearish narrative was around sort of the EVs were going to take market share away from internal combustion engines globally. And I think what's actually going to happen is, and what is happening if you dig into a lot of stats, is that it's going to be hybrids are going to play a really big role. And hybrids actually have a higher loading of PGMs than straight internal combustion engines. And so that's going to hold up demand. As a result, I just think that's a great place to sort of park money, almost sort of a positioning for scarcity. If I was kind of to break down my sectors, it would be like a just hunting for peak scarcity, hunting for energy resiliency, and then if I'm going more the income side, like what I was talking about for Hugo, it's more sort of like sustainable shareholder yield. Like, yeah, how can I find a business that I think is going to spit out dividends for the next decade and protect you against inflation and have a good moat? Because I think there's an awful lot of businesses that are going to be pretty much like three big risks if I was to break it down. One risk is like you get eaten by inflation. Like if you're going in with a high multiple and inflation
Mm.
really picks up, then um, when if you got like a high multiple, then the majority of your valuation's backloaded and you get crushed with higher structural inflation. You've got the China risk, which is you're going up against China, and China loves to drive margins to zero. And so you could like
Yes.
the cleanest explanation for that's like EVs, like they got laughed out of the room 10 years ago, and they're not laughing now.
No.
And then the last one is one that we've kind of seen priced, but it's like what's AI going to do to a lot of the sort of capital light tech companies back end valuations? Like do these companies deserve like really high multiples when if AI continues to scale like it is, like if someone can code up something, how much of a moat do a lot of these companies actually have? What do they deserve to earn? And so, yeah, with those three kind of risks, I want my portfolio to be have a really solid moat against them.
So, any particular names, Ferg, if you think about your favorite idea or favorite three individual stock names through the rest of 26 and beyond, anything in particular that comes to mind you've got the most conviction about that you think you can make the most money on?
With all this volatility, I've been absolutely banging the table about just owning trading houses. Like that's been
Yes.
a really obvious one to me. Like Shell's got the largest trading house globally, and I couldn't believe my luck when it kind of got smacked, like along with oil on the sort of a month or so ago. And they've just announced their earnings a day or two ago and just knocking it out of the park. They don't actually disclose their trading earnings, like they keep it very opaque. So that's a sort of business I love, and I love the fact that you've got 4.5 year options on them in
On
Europe
Shell.
on Shell, yeah, and they're super cheap,
Okay.
yeah,
Didn't know that.
dirt dirt cheap, yeah.
The last time I bought options, I'm embarrassed to say, in early June, I bought the July $88 silver calls, which didn't work out so well. But the 4-year ones in sounds like I've got much more runway for time on Shell.
Yeah, well, that's a whole conversation in itself. Is option pricing. Options are generally priced very accurately short term, but I've found because that was how I actually left my job was trading options, and found you want to be a seller in the sort of 3 to 6 month window, like a covered
Mm.
calls, never naked. But yeah, Black-Scholes seems to break down somewhere past like leaps, like 2 years, 2 years plus. Like once you go out 4.5 years, which you can in Eurex and the Amsterdam exchange, that that back end of that option, like I've had a lot of luck with making money. And this is also just like empirically looking through my trading results. Like I've some of my better performers have been sort of capturing these because I just feel they're mispriced further out because this is not great at pricing implied volatility, and you've just got a whole lot of factors that can move in your favor that long out. It's similar to my trading actually that I've always said that my style is quite like backloaded. Like I often take a drawdown, don't have much to show in a year, sometimes even two, and then
Yes.
suddenly year 3, year 4, year 5, I make bank. And so that's something I've seen over and over with my own style.
Yeah. Yeah, if you're contrarian, and you're trying to pick the bottom, it's kind of impossible to get the turning point right. If you know you're early, you gotta buy it cheap, but, you just never know when the market sees what you think you see. It could be months and sometimes it's years.
Yeah, you got to be prepared to get quite beaten up at times. Yeah, it's just goes with the style. Picking the bottom's always a hindsight exercise.
Yeah. And so, yeah, oh, by the way, as this is Cat Calls No Fear Finance, junior mining, I enjoyed in your trading rules of thumb, there was a chart about the junior mining share price against the dilution.
Yeah.
Um, it's it's kind of the opposite of the buying value, businesses with moats that are. I mean, that's the definition of fragile as a junior miner or explorer. Are you brave enough to be involved in any of those at the moment?
No, no, not really. I'm trying to think. I have one or two juniors that I just use as absolute call options. I kind of view the dilution as almost like a time decay option.
Yes.
Generally, I try and create my optionality in different ways if I can, like kind of using the Shell example. Like I've got 4.5 years time and I know they're running a 6% buyback and they're just going to push me through my strike price. Can I underwrite that buyback? I think I can from here. And so that kind of sets up its own version of asymmetry for juniors. I've definitely been involved with it, but I just find it really hard. I think it's better left the experts if I am going to get involved. Like I own GDXJ, like I just have the basket approach for
Yep.
gold juniors. I just went through the whole space and I'm like, I'm not smart enough to make good choices here. I'm just happy with the beta of the sector. Whereas PGMs, that's where it gets interesting. Like, because you have so few names, you just need to do the work. And I think it's hard to beat Valterra there. I own a big position in that. If you look at they're one of the only ones that have got true long life assets. And when you kind of keep narrowing down where you get all the high splits and platinum and rhodium is just pretty much one little area of the bushveld. And so
That
for
was
them,
the Valterra Ferg was the Anglo-American spin out of their PGM business, right?
exactly. And so
And I
there's a,
recall their Mogalakwena is their gigantic big open pit it's on the
yeah,
east limb? Yeah,
yeah, yeah, yeah. That's the one that's got an 81-year mine life. And
right.
everyone
Good,
else, Impala and Sibanye, both of their, if you bring up their mine life, it falls off like 40% in the 2030s. Yeah.
right.
Valterra's just got a nice steady mine life out for decades and decades to come, and it doesn't gets a bit of a premium, but it doesn't get that much of a premium for it, which I think it will if PGMs go where I think they will. Which I think the right analogy is just to look back at what they did in the early 2000s. I think it's not crazy to expect them to do sort of 5-6x from here.
So that's not you're not taking a view on I mean, you've mentioned hybrids over EVs, so we're still gonna need, PGMs to clean up the catalysts coming out of the hybrids. I understand that
Mm-hmm.
point. Are you taking a view with the Valterra or the PGM long on things like fuel cells using PGM for catalysts in the future, or is it just a bet on hybrids versus EVs?
With platinum, it's not because platinum's got a lot more drivers. You've got quite a lot of industrial activity, which is why if you pull up like a platinum chart, it almost overlays perfectly with a lot of emerging market charts. Like it overlays almost perfectly with like Brazil for the 2000 period. And that's because it's platinum industrial's a big driver. You've got, obviously catalytic converters are a big driver. You've got the precious metal side of it. And so, unlike palladium and rhodium. Rhodium's by far the most concentrated, and 85% of it's just purely catalytic converters. So that was the one that got the most murdered, and that was the one that I went after the most heavily, just to express this whole thesis.
That was palladium,
Rhodium.
rhodium. Okay.
Rhodium is palladium on steroids when you dig into it. Yeah, it's very, very concentrated. Like it's the
So
only
small.
high splits are in Bushveld really, because all the vast majority of what's been developed in the PGM space is actually palladium heavy in Zimbabwe and Nornickel in Russia, but it
Mm.
has extremely low rhodium splits. So rhodium's only 1-2%, whereas in Bushveld it gets up to 8-9%, and that stuff's in heavy decline. And so yeah, I'm a massive PGM bull for the long run. The only issue is you have to go into South Africa to buy it. And so how I've kind of built my position is I've got heavy positions in rhodium, physical platinum, and then a pretty much an equal size position in Valterra. And so if Valterra does something crazy, gets nationalized, gets taken out, I'll be hedged by my physical positions doing something absurd because they're a big chunk of global production.
Wow. Yeah, I have a friend who lives in New York, and I recall an anecdote from a South African PGM developer I financed 10 or 15 years ago. Name of the company was Platinum Group Metals, and I recall the CEO of the company at the time explaining that one of this New York hedge fund manager had actually bought in his bag, his gym bag, to the presentation, some physical rhodium, and it was so valuable that he was taking it with him wherever he went around New York. It's remind me, how valuable is rhodium per ounce?
Uh, what was it now?
I recall it going to
100,
as like,
120,000. I'm trying to work out. Was that per ounce or per gram? Let me just bring it up.
and so you think rhodium can go up multiples from here, August 2026,
Per USD per ounce, currently 8,200.
8,200, right? Yeah, and I have a recollection that back in the COVID era, it was like $15,000 an ounce or something, and maybe even squeezed for short periods to tens, to 20 or $30,000 an ounce.
Yeah,
So you
so
think that can still go up a multiple from here?
yeah, when you consider how valuable, how little inventory there is, like that's this fascinating. Like no one even talks about rhodium. It's too small. No one cares, and so it is largely market done on long-term contracts. And when anyone needs it, because it's hand to mouth, they just have to go on the spot. And then I think it's had 5 bull markets where it's done 10x plus. Some circumstances it's done 30x plus. And so understanding that and understanding the long-term outlook of South African PGM supply seems to
Mm.
me if I have a decade time frame, I might get that sort of a return if I'm willing just to sit back and keep a close eye on how much has been poured into capex. And simple answer is not enough. And even looking at all the prospective rhodium deposits globally, I can't see anything that would even threaten the thesis. And so yeah, I'm happy to sit on my physical rhodium. Granted, buying actual physical rhodium's damn near impossible unless you're prepared to pay. When I looked, I haven't looked for over a year now, but when I looked, it was about 16, 17% spread, and they wouldn't let you transfer it between vaults. So I assume you're going to get on the exit as well, probably even worse.
Do you own the physical metal, or do you own the
So
ETF?
I own an ETF that's based in South Africa. That's actually really
Okay.
a pain in the ass to get a hold of, but it's actually surprisingly, people look at it and they think it's a dog, but it's just because they only issue shares when it trades above NAV, and so it actually looks really liquid, but it's not when you dig into it. And so um, that's the majority of how I own rhodium.
Gotcha.
And that, so where I was going with that as well was platinum has had
Yes.
it's a similar story that I keep coming across is China, and anything that China can't corner, it corners the above ground inventory.
Yes.
So last night I was trying to get to the bottom. There was this Bank of America report that was saying 85% of platinum above ground inventories is now based in China. And I knew there was only one guy that's done the work, and his name was Dr. David Davis in South Africa, and he was a
I've met
PGM
David,
specialist.
yeah.
Yeah, unfortunately, he passed away. And
Oh,
I was trying yeah, yeah, he passed away, I think at the end of 2024. Yeah, unfortunately, he was the guy that understood this all. He was the guy that was kind of warning about this. And when I saw this Bank of America report, I was like, did someone do the work? And then found out they were just referencing him. But fortunately, what went with him was he was the only guy that was kind of on top of this. And the World Platinum Council's not the greatest. They've thrown out since the start of 2025. There's about 3 months of above ground inventory, and I just saw their recent piece come out, and it said again about 3 months of above ground inventory, and they're not really identifying just how much is in China. And this is largely because China has cornered the what hasn't cornered in terms of just sheer commodities. It's cornered the processing and refining and the vast majority of commodities, but it couldn't get that with PGMs because it's actually refined in South Africa. And for a whole lot of reasons, one of them being some of the crazy sort of diversity policies that South Africa's put in place, the Chinese couldn't actually get large stakes in the PGM refiners. So what they've done is they've just bought up the
All the metal.
all the metal they can. You can still see this today is platinum trades at about a 10% premium. The platinum futures versus COMEX. So the West versus East has traded consistently at about a 10% premium. And so you can just imagine as this giant vacuum cleaner sucking out all the physical
So
globally.
the Asian PGM price trades at a 10% premium, hence all the physical metal moves to Asia.
Correct. Yeah.
Right,
And they
which is the
don't
same in gold silver, right? If you want us to
exactly.
figure out where the gold silver price is going, look at the premium or discount, and when it goes to an Asian premium, that tends to anticipate where the price goes.
Correct. And so it's just it's just interesting. It's zero idea when it'll happen, but to me, it suggests some pretty disorderly pricing somewhere out in the future because the Chinese also don't export platinum. They only export it in terms of value added goods. And so it doesn't matter if Japan, if the Europeans are hand to mouth and they suddenly run short, they're not they're not going to save them. And
Yeah,
if anything, we've seen it recently with like products with China, like or even fertilizer, like with the war. Just you've got a surplus of fertilizer. Can you please? Like India was begging them, and they just sat on their hands and said, "Yeah, sorry," and followed suit with products for a period there as well.
yeah.
Chinese aren't gonna save shortages and stuff that's in their interest.
Well, another idea, Ferg, on how we try and figure out where PGMs are going is to look what Sibanye-Stillwater are doing. You mentioned them earlier. They're one of the 3 or 4 investable companies. I recall that they bought the default industry expert on PGM metals, SFA, Steve Forrest Associates.
Mhm.
And around that time, they went and bought the Stillwater PGM mines, palladium mine in North America, which turned out to be the right thing to do because the palladium price went up a lot. They've got that IP sitting inside Sibanye Stillwater. I also recall they bought a US recycling, PGM recycling business. So if we look what Sibanye does, that will give us a clue in terms of where the prices are going.
Yeah, yeah, no, I've owned Sibanye and yeah, sold out ultimately for Valterra on the mine life. But yeah, I think you do well in all of them. Yeah, I think it's probably overthinking it to not think they all benefit. And Sibanye's got a decent amount of torque, higher cost, still got the debt. Yeah, I just
Yes.
dislike some of the money they burned on some of their green projects.
Yeah, yeah, agreed. I think the market doesn't think much of that either. Do you mind if we change the subject to tin, which is I've heard
Certainly.
you talk about before, dear to my heart. I've got plenty of shares in Metals X investee company called First Tin. What's your view on tin at the moment, and maybe in the context of PGMs? Clearly, you like PGMs. Where does tin fit in the world of future metals and potential price action?
Yeah, so tin was always I just love little niche metals which I can't see that much of a supply response. And so that was what first got me interested in I just couldn't understand where the supply was going to come from. I think it's been proven out by what's gone on in Myanmar, even with it ramping up. An interesting chart to look at the moment is the Shanghai tin inventories. It's really breaking down. And last time it
Yes.
broke down, we had pretty disorderly upside price action. Granted, we're already at a high level, but that's breaking down substantially. So they're not. Myanmar's started to ramp, but I always subscribed to the idea that they'd largely high graded their tin. Like there was a lot of like alluvial tin, very easy to get. Myanmar, they've obviously had some unrest, and as they're trying to ramp up now, a lot of it's they're having to go underground. It's a lot more difficult. There's kind of some flooding issues, and so I don't think they're ever going to get back to where they were. Indonesia's also had its own share of issues as well. Not before even getting to what was announced a month or two ago with a sort of reintroduction of monopsonies, the idea that they're going to run all the Indonesian commodities through a state entity, and that state entity will do the pricing. Tin hasn't been mentioned yet. It's only been coal, palm oil, and ferroalloys or nickel. But there is a clause in it that they will continue to review other commodities out of Indonesia, and so it looks like it's not a big jump to see if tins keeps making new highs that it'll come to um, the government's attention there. The Indonesians love to, if everyone should have a look at the history of when they last pursued sort of monopsonies across Indonesia in the late 60s, 70s. It's not good for the not good for the exporters. It's essentially sort of handed to families. They take all the sort of pull all the free cash flow out of the companies, and supply um, has a rough time.
Mm.
And putting that all together, the supply side just looked like a gift to me. And so, yeah, I have a large position in Metals X as well. I think it's cheap. I think there's a lot of optionality there. I was hopeful that they might get green tech across the line, but that doesn't look that likely. I see there's a little bidding war going on with some other players for green tech now, so no idea how that plays out. I think Brett's a smart guy. I like any doubts I had with some sort of silly acquisitions back in the day. I think his strategy at the moment makes a lot of sense. Acquiring the juniors is smart here, I think, especially when they're in the vicinity of Renson. And then, yeah, you got the buyback as a potential catalyst as well, sitting on a big chunk of cash. Um, about the only negative on the thesis is the link to tech, and obviously the factor that could play if we do have a large sort of a bust in the, especially like semis, like 50% of tin demand is solder.
Electronics.
Yeah. And so you could get rug pulled in that. Granted, like, yeah, like it's still so cheap in Metals X. Like yeah, it's, it's hard. It's one of those hard ones because you could definitely see a big chunk of demand evaporate if there was a really bad bust. And so I even saw one article that was calling tin a bubble at the start of this year. So it's the first time I've had a sector I'm in be called in a bubble for a while. I don't think that's ever seen that before. And so, yeah, that is definitely on the radar, that there is a tight link to that post COVID, when there was like a real surge in people buying electronics because under lockdown. And when that rolled over, that obviously took tin with it. So, yeah, mindful of that. But I kind of always joke it's my AI play.
Yeah, well, a derivative on AI, as is uranium, reminds me of a conversation I had with Justin Hoon, the uranium insider, recently, and that risk you just mentioned for the one that we have a tech correction and therefore a uranium correction. I think you're exactly right. It applies to tin as well, because these metals are the ones that are, or in the case of uranium for nuclear energy for the hyperscalers, are the ones that we're still going to need. And obviously, the demand doesn't go up in a straight line, and the stock market will correct as well. But it doesn't change the underlying structural demand story in the case of tin, meaning that we're still going to need more gadgets. We still
Yeah.
need tin to conduct, move, store electrons. As you said, the supply side is important, and it's constrained because those three countries, Congo, Indonesia, Myanmar, are all producing less of it than they used to. And demand, AI doesn't seem like it's going away, although clearly the stock market will have a correction on the way through. By pure coincidence, I happened to meet the Metals X chairman, Peter Gunsberg, here in Perth today, and I think they're still hopeful on green tech. That would obviously be the most sensible thing for them to do, would be to buy more of their Renison tin mine in Tasmania. I think their view is they've got their foot on all the legitimate development plays, including First Tin, which I'm also a shareholder of. And they will support those companies in becoming future tin mines. And I think their partner, Metals X's partner, Yunnan Tin, Peter was telling me, I mean, they produce about 75,000 tons of tin a year, of which about 45,000 tons come from China, and the other 30 they need to find externally. So that's Renison for Metals X and these other tin mines that they're involved in. So, yeah, I think the conclusion of that is there will be a correction like there is in all markets, but the structural growth story and therefore the longer term thesis, I think, is a reasonable one.
Yeah, well, I think the expectations aren't crazy for it either. Like, I actually, I haven't looked at it in a while, but yeah, it's, what are you, like 4 times EV to EBITDA, maybe five? Like, yeah, you look out, like, of course, you always got to be careful of a commodity, saying how cheap it is when the commodity's making all time high. Like the
Yes.
classic mistake of saying something's cheap on a price to earning basis when the commodity's about to collapse. But yeah, like where's the supply going to come from? Yeah, it's trickier, but yeah, definitely it's hard to judge how much tin demand may AI have pulled forward. And like, yeah, that it is something that I kind of keep in the back of the mind.
Yeah, agreed. Yeah, well, Metals X ain't expensive, right? I think I read the last quarter they produced $100 million of cash flow for the quarter. Times that by 400. My recollection is they've got now about 400 of cash, and market cap's around a billion four. So that means you're on 2 or 3 times EBITDA. So even though it's a single commodity and therefore riskier than a diversified miner, that's not expensive. If anything, the market's discounting a correction in the tin price with that multiple.
Yeah. Yeah, agreed.
Fergs, anything else you think we should talk about today, mate? Or we'll come back and live to fight another day and see how the oil services, the tin, the PGMs, and the emerging market exchanges have gone. What do you think?
Yeah, I think we've covered some good ground. The only one that I'm kind of paying a lot of attention to lately has been the sort of lack of energy resiliency across Europe.
Yes.
There's quite a sort of debate going on at the moment that Europe will be fine and it'll get through this winter. Um, but the gas refill for EU storage just broke the lower bound of the last 10 years. And since people argue, like, oh, it doesn't matter, like, demand's down sort of 18% over this period. Obviously, your industrial output's shrunk, so it needs less. I think what there's a problem with that thinking in that a lot of the resiliency has been taken out of the system. Obviously, they've lost a lot of their gas pipelines in. They've shut down Germany, shut down a lot of the nuclear plants. They've mothballed a lot of their coal. So they've taken the resiliency out of winter and patted themselves on the back for increasing renewable output.
Yes.
And the problem
Yes.
renewables is you obviously have, like I looked at Germany and it peaks out at about a quarter of its grid runs on solar in the summer, and that reduces to, in the coldest month in January, it's about 3% of the grid. So you've got to replace that, and you've also got to account for wind, which makes up a big chunk of their grid, can just disappear. They can have what's it called, Duncan fluke, like wind drought, and it just disappears. And so the talking of like an average isn't actually the right way to look at it, because you have, like, it's how much can be brought into the system quickly. I think of like I always loved Howard Marks' observation that, like, the 6 foot man that drowned in the stream that was on average 3 foot deep. And it's like being
Hmm.
very careful of averages when you have like large outline events. Like if they have a cold winter, gas can't overcome the has to make up that entire shortfall because they don't have the nuclear there anymore. They don't have as much coal. And Germany is actually one of the biggest laggards in refilling capacity, which is interesting because it's obviously EU's, like, it's behind, but Germany and Netherlands are behind the most. And so, yeah, I find that interesting. That's why I remain sort of, I love Shell as a way to play it. With they they've obviously got a big LNG book, so they benefit from uplift. They've got the trading house, which benefits from volatility. They've got the refining, which is obviously, I saw their report recently. It's running at 102% utilization at the moment, so that's printing cash. And obviously talk to Brent. Then you've also got like the second order, which will be coal. Asia's obviously using using a lot more coal with Qatar being offline, and I do see a scenario in which Europeans are forced to really increase their coal utilization this winter. Depending, if we get a really warm winter, yeah, they'll be able to get through. But seems that's a it's a coin flip at this point.
Yeah, well, the unfortunately, as you say, Europe has compromised its energy security by going importing Russian gas, importing someone else's gas. I read over the last few days that Italy is talking about going nuclear because Italy is almost exclusively gas, which becomes really high cost when you run out of it. And it will take a long time for Europe to rebuild its energy security and diversity, I'm sure. And unfortunately, the European industrial base will pay the price in the meantime. But I like the 4 year Shell call option idea. Ferg, I'm going to take a look at that.
Yeah, with that, it's just can you underwrite the dividend, the shareholder yield? Can you underwrite the buyback? Because those long dated, so when you buy a super long dated call like that, it's obviously reprices in the dividends into and it
Yes.
discounts the option. But long dated options don't have any pricing model for buybacks. And so if you're constantly shrinking the share float and they're paying down debt, you can mechanically kind of push yourself well through the strike. What Shell at the moment is buying back 6% of its float roughly, and that is sustainable at about $50 a barrel. And yeah, we're well above that. And so, and I see their trading arm continuing to really outperform. Refining's going to print money. LNG is obviously what are we, as we're talking JKM, like Asian LNG is in the 21, 22 range, which will be continually pulling those flexible contracts from the US, and Shell prints money on the back of that. And then, yeah, they've got the oil talk as well. So, yeah, I think if anything, it's all going to continue to surprise the upside. And that's before you don't have to put in any crazy figures for TTF for the winter. Like I'm happy with where we are now. Anything else is like gravy, and that's always how I like to. And the options are quite cheap on an IV basis. So yeah, if the whole thing makes sense, even if we get a warm winter, that's where I love to be. Like I'm not risking too much, and if it all comes off, then I get a big free call option.
That's what we like, asymmetrical upside, free call options. Ferg, mate, thank you so much for taking the time today. I've got some great new trading ideas, and I think despite your 40 years of age, you're a younger man than I am. You're a lot more sensible, and I'm sure that you will achieve your own wealth goals, whatever they are, and pass on some good lessons to your son. I'm going to try and learn from your wisdom. Thank you.
Thank you, Simon. Yeah, I've made a lot of mistakes early, so just quicker at making mistakes, and hopefully, I always say like
Exactly.
a sort of a trading rule is just a big mistake that every time you think of breaking it, the memory's too painful, and so that's why you'll stick to it.
Think of the pain when you broke it last time. Yeah, exactly. That's the point. It's only a mistake if you don't learn from it.
Exactly.
That's our mutual assurance to each other to learn from the mistake each time. Thanks, folks, for your time today.
Thank you very much, Simon. It was a pleasure.
If you liked what you heard or read today, can I ask you, can you press like, share, or subscribe? You can find all this information on our website, catcalls.com. Note the cat is spelled with a double T, CATTCALLS.com. You can find the podcast on all the major channels, Spotify, YouTube, Apple, etc. I'm going to try and bring you the content that you want on a regular basis. And if you can follow us, then we're going to get you better content on a more timely basis to have more fun and hopefully make some more money. Thank you so much.